The market is making moves, but it's not because of tariffs. Today, we're breaking down Wall Street's bullish bets, California's huge changes to self-driving car rules, and Tesla's explosive move on Friday, and where it could be headed next. Plus, we'll preview this week's massive tech earnings and key economic events you need to watch. And big news, our value investing mini-series kicks off this Saturday. Make sure to like and subscribe, follow wherever you listen to podcasts so you don't miss a beat. Now, let's get into it. Welcome back to Stockcast, the market show for the average Joe. Whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. I'm your host, as always, Brandon Shar. Happy Sunday, folks. Let's jump right into it. First of all, let's take a look at the big picture. Right now, Wall Street sentiment is very interesting. We have had recent bearish activity, I guess, over the past couple of months. But as of right now, things, at least in the short term, are looking bullish. I found this very interesting article through Webull, directly from Benzinga, back on Friday. And it says a rare technical signal is drawing attention on Wall Street, pointing to possible gains for U.S. stocks, even as tariff concerns from major companies raise risks for the economy. According to Benzinga Pro, the S&P 500 is tracked by the S&P 500 ETF Trust SPY, has gained over 5% in the past 5 trading sessions, driven by strong buying momentum across sectors. Tesla, for an example, surged 10% to 285.50 Friday afternoon, heading to its best weekly performance of 2025 with a 24% gain. Very interesting here, as this article points out, particularly over the last 3 trading days, more than 70% of stocks on the New York Stock Exchange posted daily gains, a clear sign of widespread market participation. That's really the key word here that grabbed my attention. So we have seen instances where the Magnificent Seven, the largest companies in the U.S. stock market, are, in a sense, kind of artificially propping up the overall market, right? Where everything else is either chopping around or bearish, but yet because of the weight of some of these larger companies like Apple, for example, or Tesla, if they're exceptionally bullish, they can, be holding up the market. And basically what this article is proposing and saying is that that is not the case right now. Instead, what we're having is that the majority of stocks are up right now. So I found this very, very interesting. The last time a similarly strong buying streak extended to 4 consecutive days was during the rebound of April 2020 following the pandemic-driven crash. So that's also very interesting, because if you go onto a chart for, let's take a look at SPY, for example, for those who are on YouTube, and we just take a look at the past 5 years. Obviously, we had the low back in the COVID era, right? 2020. And then what did it do? It just went up, right? And so essentially what this article is saying, what it's proposing, is that we're kind of now setting up in a similar position where you have what you would call this market breadth, where it's not just a couple stocks holding things up, it's the vast majority, right? So according to this Ryan Detrick, chief market strategist at Carson Group LLC, he highlighted the significance of this rare breadth thrust, as he puts it, noting that the S&P 500 finished higher 1 year later in 27 of the past 28 similar instances. So from a statistics standpoint, those are excellent odds that there is a very good chance that this buying that we're seeing across the market at large is going to continue over the next year. A breadth thrust occurs when a large percentage of stocks rally together over several sessions, and indicating broad-based investor enthusiasm rather than isolated leadership among a few mega cap names. Historically, such patterns have preceded the start of major bull markets. So it's very interesting to me that we are seeing the vast majority of stocks that are up right now. According to this article, right, we had 70% of stocks in the New York Stock Exchange that were up this past week. And so it's not just a couple names. It's not just Apple holding us up. It's not just Tesla. It's not just Nvidia, right? It's the vast majority. So the fact that majority of the time when we see this kind of market breadth, this thrust of buying a bullish action, 27 out of the past 28 times, things have been higher a year later. So drop a comment, let me know what you think. Is this just one massive bull trap, or do you truly believe, as this article seems to allude to, that we've already hit the bottom, right? And now we're beginning to climb up. And so if that were the case, right, then as a value investor, right, this is where you want to be buying. Really, you wanted to be buying a week and a half, 2 weeks ago, right? But in either case, basically, the point is very simply that we are seeing a change in the market of late, right? And it seems like buying pressure is starting to hold. All right, moving on. Found this interesting piece on basically California's self-driving regulation. So we did talk about last episode how federal regulations were loosening up on autonomous vehicles, and found this interesting piece on California. According to CNBC, California overhauling self-driving vehicle regulations governing Waymo, Tesla, Zoox, and others. So basically, the rules would impact robotaxi leader Waymo, as well as would-be competitors, including Tesla and Amazon-owned Zoox. So, interesting article here, basically in light of everything that's been going on a federal level, right? We're seeing the state of California now making some changes basically to how they are going to approach the situation. The new proposed rules by California would also allow autonomous trucks weighing 10,000 pounds or more, 10,001 pounds or more, to be technical, to be tested on California's public roads. So that's interesting. They would also require all AV makers operating in the state to adhere to new data reporting requirements and comply with the state's standards for driverless vehicle interactions with first responders. California's updated regulations were announced after the National Highway Traffic Safety Administration said it would relax an order requiring automakers to report data on collisions that occur while drivers are using their partially automated or more advanced automated driving systems. So it does seem like California is taking a step towards making autonomous vehicles a bit easier after seeing on the federal level, the easing up, right, of regulations, cutting of the red tape, so to speak. So this is interesting for anybody in the autonomous vehicle space, such as Tesla, such as Waymo, and really these cars are wild. These cars that can just drive you all over without anyone in the driver's seat, fully automated. It's pretty wild the time that we live in. I had a work trip out in Phoenix, Arizona back in February, and one of my coworkers hopped into, I think it was like an Uber or something, and there was just no driver in the front seat. And it took him right to the airport. It was the wildest thing I've seen. So This seems to be the future. It seems that the federal government is easing regulations. They're loosening the red tape on certain safety restrictions, I guess. And now we do see California that is proposing, some easing of the regulations as well. So the California DMV is accepting public comments on the new proposed AV regulation through June 9th, 2025. So if you want to get a comment in, you got until June 9th. So very interesting new rules for testing and deployment of self-driving vehicles on the way for the state of California. And that kind of leads me into my next piece here, talking about companies that can benefit from this. How about Tesla, folks? We talked about this in the last episode. I'll pull up the chart here in a minute for those on YouTube, but I talked about how on a very short-term basis, right, wasn't guaranteed, but it did look like Tesla was gearing up for a breakout, and folks, did it have a breakout on Friday. According to Yahoo Finance, Tesla stock surges 9.8%, clinches 18% weekly gain after DOT unveils new self-driving car rules. Tesla stock surged 9.8% on Friday, clinching a weekly gain of 17.9% for the stock as several positive catalysts pushed the company higher. The latest positive headline for the company came late Thursday when the Department of Transportation rolled out a new framework for self-driving car regulations, including streamlining some reporting requirements for cars equipped with automated or driver assist systems. So beyond just the technical setup, right? And that's one component. But then if we look at it from, not just by looking at the chart, but thinking about some of the news catalysts coming out, maybe more of what I would call the fundamental side. Tesla has been getting that news as well, as we just read. And basically, according to Transportation Secretary Sean Duffy, quote, "This administration understands that we're in a race with China to out-innovate and the stakes couldn't be higher," close quote. So basically, we're competing with China, and companies like Tesla and Waymo are going to benefit from it because the federal government wants to cut the red tape so we can get the innovation quicker than China can. We want to beat them to it. So there's an incentive here for the government to make it easier on these types of companies. So it's very interesting. CEO Elon Musk said on the company's earnings call this past week, that Tesla expects to be, quote, "selling fully autonomous rides in June in Austin, as we've been saying for now several months." So that's continued, unquote. So basically they're going to continue to stride towards this autonomous vehicle situation. They're going to have these rides out in June in Austin, so that's interesting. Musk added that the future of the company is fundamentally based on large-scale autonomous cars and large-scale numbers of autonomous humanoid robots. So the value of the company that makes truly useful autonomous humanoid robots and autonomous useful vehicles at scale at low cost, which is what Tesla is going to do, is staggering. So he's basically saying that's the future. The future is autonomous vehicles. The future is humanoid robots. The company that is able to successfully do that with decent margins, the value on that company right now, is what he is saying, is massive. And he's saying that's exactly what Tesla is doing. So definitely something to keep an eye on. It looks like Tesla stock, according to Yahoo Finance, also getting a boost from a Bloomberg report that indicated the company could be close to entering the Indian market after some customers received a notice that their reservation deposit would be refunded. So basically, Elon is trying to be very careful, trying to figure out when's the right time to enter the Indian market with the tariff situation, waiting for some of that to boil over, right? Figure out where, wait for the cards to settle, I guess is a better way of saying it. So Friday's moves built on an already high flying week for Tesla stock. Shares got their biggest boost earlier this week after Musk said during the company's quarterly earnings call that he would be cutting back his time spent in the Trump administration significantly. So that's also huge. So you have a few different things going on here as far as positive catalyst for Tesla, right? You got this India market thing that might come through. You got the autonomous, vehicle regulations getting eased a bit. You got Musk saying he's coming back. So hey, these are all positive things for the bull camp when it relates to Tesla. Um, which, again, is part of the reason why I said on the last episode in the short term I was bullish on Tesla. Take a look at this. This is the chart for Tesla over the past year. Now, real quick, um, some of the lines you see on here for my folks on YouTube, this is called Fibonacci retracement. Very simply put, because I don't want to get all into it right now, but very simply put, you take the low and the high of whatever time frame you're looking at. Longer time frames are more reliable. So I'm looking at a 1 year chart. So we're looking at the low and the high, and then basically we get these ratios, right? These levels that tend to, get respected, and they can be viewed as areas where, a company after going up a ton, in this example, like Tesla, might pull back to before it continues higher. So it's something to use for potential entries, right? And to see what levels may or may not hold. Very interesting how, these levels can hold up. You can see here back in February, this 50% ratio, right, at 327.97 was respected initially, and then it did, crash through that to the downside. So, anyways, let's take a look here at basically this massive green candle we had on Friday. It was a massive day. It was up nearly 10%, one of the best days it's had since December 2024. Now, there was this breakout I was looking at, right? You had this descending level, this descending trend line of resistance. We did get the breakout above that. And significantly, we did close above the 50-day moving average, right? And so really the next spot that I'm looking at as a Tesla bull here in the short term, I want to see if we can get above the 200-day moving average, which is currently sitting at 291.34. That just also happens to be the 61.8% ratio for the Fibonacci retracement. Basically, it's just a very significant area, right? So anywhere around that 291, that is a huge, huge area. I also have it marked out as, the recent high that we had just back on March 27th. So getting above that on a time frame such as this, these daily candles, if we are able to get up here in this, just above 291, if we can touch like 300 and close there from a higher time frame such as this, it does appear like we are kind of bottoming out on Tesla, finding support, and now starting to climb back higher. So I am very happy with my position currently. I'm sitting in some calls. I forget what I got now. I think it was 301. Yeah, 301 calls, I think, expiring on Friday. So I picked those up right around 10 a.m. on Friday. So obviously those are up huge right now, up about 100% on those. I'll probably be looking to, not probably, I will be trimming out of those at the very least tomorrow at the bell. I'm hoping we get a nice gap up. A perfect world for me right now would be if we can gap above 291 at the bell tomorrow. We'll see what happens. We haven't really gotten any new news as far as tariffs over the weekend. So I'll be curious to see what futures look like when they open up later today. But that's Tesla right now. Now, I would also say that if we fail to get above 291, we could see another leg down, of course, probably break this this area of 220. But as of right now, things look very, very nice for the Tesla bulls. And keep in mind, this is such a volatile stock, folks. This is a very, very high beta stock. And so, typically whatever the stock market does, you can essentially just, 3, 4, maybe even 5x that for Tesla. It's a very high beta stock. So drop a comment. Let me know, what is your price prediction for Tesla? Do you think we're going up? Do you think my calls are in a good spot? Do you think I'm going to be broke at open tomorrow and we're going to, Tesla's going to open down 20%. Let me know what you're thinking. All right, moving on, let's take a look at the economic calendar. So we do have a lot of data that is coming in this week. So want to make sure that you are prepared for that. Definitely things you want to be mindful of, especially for my short-term traders. According to Bloomberg, let's take a look here at the economic calendar. And I just love this thing because you can filter it a lot of different ways for countries, things like that. But as those on YouTube can see here, we have this week laid out for the U.S., of course, but then you get this volatility gauge. Basically, you get 3 of these marks here, these symbols. These are the most volatile events that we're going to have for this week. So I just want to take a moment here to highlight those for everyone out there so you know what to be aware of, right, for the week ahead. So one thing to keep in mind this week, we do get consumer confidence for April coming out at 10 a.m. on Tuesday, April 29th. And also, we do get the JOLTS job report. This, folks, is going to be massive. It's for those who don't know, right? It's a survey done by the U.S. Bureau of Labor Statistics to help measure job vacancies. It collects data from employers about their businesses, employment, job openings, recruitment, hires, and separations. JOLTS defines job openings as all positions that are open, not filled, on the latest business day of the month. A job is, quote, open only if it meets all 3 of the following conditions. So it has to be a specific position that exists and there is work available for that position. The job could start within 30 days, yada, yada. There's active recruiting. Basically, this is just telling you where we're at right now as far as job openings. So this is something that Jerome Powell and the Fed are definitely keeping an eye on, and it's something that we should be mindful of. If we take a look at the previous number for JOLTS, it was 7.568 million. The forecast is 7.48. So that's where we're at as far as JOLTS. And, just to kind of put it in context, right? A strong JOLTS report would mean more job openings than forecasted, right? So a stronger than expected JOLTS, more employers are looking to hire, more openings than economists predicted, right? So that would be a strong JOLTS report. A weak expected JOLTS equals fewer openings equals labor market cooling off. So the interesting thing to note here is that if we do get a strong JOLTS report this week, the Fed would be likely less inclined to cut rates because a strong JOLTS equals a tight labor market, equals wage pressures that stay high, equals inflation could stay sticky, right? Now, if we get a weak JOLTS report, that could suggest that, things are cooling off a little bit and the Fed gets, a bit more comfortable with cutting. As of right now, we're looking most likely at a June cut, but we definitely want to know where we're at with the labor market. So this is definitely something to pay attention to. And again, that comes out on Tuesday, so we'll see how that ends up. Some other things to be mindful of. This week on Wednesday, ADP non-farm employment change comes out for April. We also will get the GDP report, which will be very interesting. That is coming out for Q1. Previous was 2.4% and expected is 0.4%. Now this is quarter over quarter, the numbers I'm giving you. So gross domestic production, definitely something, we should be paying attention to. So that comes out, Wednesday. So and then also on Wednesday, we do get the Fed's preferred inflation gauge, the PCE price index. So that comes out on Wednesday, and that is massive. Definitely something you want on your radar, definitely something to pay attention to. We've talked about it before. Personal consumption expenditure, right? So it's basically gauging the cost of the various things that consumers are buying, and it's adjusted to not reflect like energy costs, things like that, unlike CPI. So definitely, again, we got a huge week of data, folks. Like, there's a lot on the plate here. If you're an active trader, this is going to be the week you want to be paying attention to, because you're getting inflation, you're getting job reports, right? We're going to get GDP forecasts. I mean, there's a lot going on. So, as far as some of the more volatile events, Thursday we got manufacturing PMI that comes out at 9:45. So pay attention to that. Friday, average hourly earnings, 8:30 a.m. that comes out. You got non-farm payrolls also at 8:30. Unemployment rate at 8:30 as well. Boom, 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 right out the gate on Friday. So even on a Friday, right, where you're already thinking about the weekend, you're like, you know what, the market's going to be slow today. And the minute you think that, and those numbers drop at 8:30 is when you get your face ripped off, folks. So make sure you're paying attention. Definitely not speaking from personal experience on that. So be mindful of that. A lot of economic data coming out this week. In addition to that, let's also take a look at the massive week of tech earnings. We have some of the Magnificent Seven that are going to be reporting this week. So definitely want to be paying attention to that alongside the economic data that we have. Major earnings reports this week. Just want to touch on a couple. First of all, you got Microsoft. Such a report earnings this week. Investors are watching closely for updates on AI investments and cloud services, especially given recent tariff uncertainties. That's a huge one. You also get Apple. That's a huge one. They will release their earnings report with analysts focusing on the impact of Chinese tariffs, of course, and the company's efforts to diversify the supply chain, including shifting iPhone production to India. So Microsoft, boom. Apple, boom. Hey, how about Amazon? Yep, they're also going to report as well, facing scrutiny over recent analyst downgrades and potential changes in consumer spending trends. So you got Amazon, you got Meta, other notable companies this week, ExxonMobil, Coca-Cola, Visa, Pfizer. I mean, folks, there is a ton going on. So between all that and everything we just got done talking about on the economic side, you got April jobs report, PCE inflation, quarter one GDP results. I mean, there's a ton going on here. This is going to be a pivotal week for the markets, in my opinion, given the recent bullish action we've seen. We're kind of in this like almost no man's land right now, even though we've had some higher lows and we look like we've established a bottom. Everything is kind of tying back to that market breadth that I led off with in that article, right? Where you have majority of companies that are higher right now. It's going to be very interesting this week to see if all of that is going to continue based off of some of the earnings we get this week from these major tech companies. Are they going to continue to add fuel to the fire on the bullish camp, and basically continue to drive us higher? Same with the economic data. Is it going to come in strong? Is it going to come in weak? I'm very, very curious to see what the jobs report looks like, because I know Jerome and the Fed are going to be watching that, and also that PCE inflation index. Want to see where that's at. Is inflation coming down? Is it, showing signs that it's starting to tick up? These are all things that are going to play into that Fed cut rate decision. So a ton going on this week. Definitely want to be paying attention. So, and then lastly, just a special announcement. I briefly spoke about it last episode. We are indeed going to start our value investing mini series. This will most likely be a 3-4 part series that will start this upcoming Saturday. We will do it each Saturday for the next 3 or 4 weeks, depending upon how I break it down, and we'll see how long it takes. But we're going to do a deep dive on real value investing, folks, starting this Saturday. So how to spot a deal before Wall Street does, potentially, right? So if you have any interest at all in value investing, make sure to like and subscribe, turn on notifications. That way you can catch it. Basically, we're going to do a breakdown of basically the way Buffett invests, folks, based off of Benjamin Graham and his philosophy. I've been reading the book. We're going to do a breakdown of that, and then I will actually break down those numbers adjusted for inflation, bond rates, because that book was written, back in like the 30s, 40s. So we're going to adjust it for today, right? And then we're going to break it down per sector, and then by the end of the series, I will actually show you how you can look for companies that meet these certain criteria, and maybe you join along with me. What I'm doing is paper trading, not paper trading. I'm using a paper trading account to buy these companies that meet the criteria. I'm gonna hold them for a year, see where I'm at, right? And then if I'm up, then I'll begin to deploy actual money into the strategy. But I want to see for a year. Again, this is investing, not trading, where things look like. So if you have any interest in investing, and you want more of a hands-on approach to your investments versus letting someone else do it, or just parking in an ETF, this is definitely a series you want to tune into. Again, not a financial advisor, but definitely want to share with you some of the things I've been learning that I find very interesting, and I think you will as well. So with that, that's what I got for you. We got a big week ahead in the markets. Stay focused, stay vigilant. We'll be back midweek, of course, for a check-in. Drop a comment. Let me know what you think about Tesla. Let me know what you think about the markets overall. We're going to continue higher, go lower. We'll see what happens. But as always, thank you for the support. We're closing in on our first 100 subscribers, so thank you for that. Make sure to share the show with a friend, anyone that you know that might be interested in the markets. And as always, folks, remember, plan the trade and trade the plan. Have a good night.